Hey guys, welcome to this week's Money and Investing Show. This week we are looking at creating opportunities within turmoil. There's no question about it. The stock market and world economies have been turned on their head with events over the last few weeks. We're going to run through some copybook plays that will help you tilt the odds back in your favor, enable you to bank some profit, and most importantly, have a game plan going forward. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olorenshaw.
Good to be back, Mr. Baxter. Thank you for having me on the show. Today, we're going to talk about opportunity, as we love in markets. Amidst what has been a tumultuous situation, geopolitics, Ukraine, Russia, and everything else in between, let's talk about how to trade it.
It certainly has. And, these events, when they come along, turn markets on their head. One of the things that we talked about when we did our outlook at the start of the year was that, we suspected 2022 would be a very different type of trading year than what we've seen over the previous couple. Not a trending market, but certainly a more volatile and choppy market. And that's exactly what we've been served up.
I know I'm testing your old age here, but diving into things, podcast number 7 of 2022, we spoke about the plays that we anticipated.
If you say so.
If you say so. The plays at which we anticipated undertaking over the medium term. Can you give us a rundown on what we spoke of back then?
Yeah, the one we were talking about particularly was in the energy space. And interestingly enough, when we talked of that, it was about the lack of investment, amongst other things, the greenification in the economy, and the oil prices we expected to have a run on it. And one of the points that I went to length to mention was that was excluding geopolitics, add geopolitics into that mix, which very obviously we've seen with the attack on the Ukraine from Russia, then things would go sky high, and that's exactly what we've seen. And it's not a let's get the kazoo out and do a lap of honor and beat our chest. The reality is there are certain playbooks that you can set your stand out for to capitalize within markets, and that's really where high level trading kicks in, which is what we do.
You have to trade your view, and back then we had a view, we traded it, and it's been quite fruitful for our clients thus far.
Look at US oil as an example of that, or XLE. Both of them have added a good 25-30% profit already and running, and there's certainly plenty more in those too.
Totally. Now, for anyone listening to this, before you go any further, go and listen to podcast number 7 if you haven't already, because that'll provide some nice context as we chat here. Can we talk about now, AB, you talk about adding geopolitics into the mix. Just a brief rundown for our listeners on what's been going on geopolitically.
Yeah, obviously, unless you've been living under a rock, or in my case, you've been flooded, in which case you've had no internet or news coverage. The Russia has obviously invaded Ukraine, not our area to comment on that in any level of depth. What our view is, being in the money space, is how do you capitalize on that? And I appreciate that may sound a little insensitive. Our job is to help our clients best serve their portfolios and investments to be able to profit from markets. And if you're someone that manages your own super, or you've had shares, you've probably had a pretty good run over the last couple of years. And let's face it, you couldn't really fail to make money over the last couple of years in the stock market. Everything's been a bottom left, top right chart. But in these times of uncertainty, you can't just simply rely on going along with the flow. And I think a lot of investors, I think it's called an amora fish. There's a little fish that swims in the shadow of the big fish, just eating all the parasites off it. You see a shark and it's got this little fish nibbling around the gills. Most retail investors have been able to sort of piggyback, if you will, on the institutional money that's flowed around and been able to make really, really good returns. Now we're in a very choppy market, and choppy, predominantly now because of, the uncertainty within the world. You've got Russia being a superpower, which also happens to possess more nuclear warheads than any other country on the planet, flexing its military muscle and invading the Ukraine. That's really sort of upset the apple cart, so to speak, as far as markets are concerned. We saw volatility, the VIX index, another trade that we talked about in that particular podcast 7, series 3, to profit from. And that's been another very, very lucrative trade. That's probably closer to 50-60% profit for our clients in that kind of position. The volatility index has gone up through the roof as a reflection of the uncertainty in markets. And this kind of uncertainty for a traditional buy and hold investor is a nightmare, because the gains of the previous year have been given back to some extent. You think about Macquarie Bank as an example. It's sort of from $204, $205 to $176 and counting. And so that profit that you've made has been given away, because we've held onto a position when in actual fact the shape of the market dictated a different approach. And I think this is something that really drives us as an organization, is to make sure our clients are equipped with different types of strategies for different market conditions. This is not a trending market. There's huge uncertainty as to where the world's going to be in 6 months' time, 3 months' time, 1 month's time, 1 week's time for that matter. And so persisting with a buy and hold strategy in these conditions really financially is not going to be particularly lucrative for you. And instead, you've got to set yourself out to either protect yourself from the risks of those markets, and once you've protected yourself from that downside, then look to engage strategies that are likely to be pretty profitable through there. And I hope people have bought insurance or put in protection or hedged off some of their portfolio, so they've been able to maintain the values of their portfolio and their retirement potential lifestyle.
It's like playing golf. I'm not much of a golfer, but I do know you need a different club for different shots where you are on the course, and markets are much the same, right?
Let me tell you, I'm a terrible golfer. I think the last time I hit 2 good balls was when I stood on a rake, but that's a conversation for another time. But yeah, you're quite right. You've got to have that flexibility within your arsenal. And I think we're moving into a market where understanding the impact of geopolitics in particular, and this then leads into, of course, fundamentals, is absolutely crucial. Now, I'm not talking about fundamentals in terms of PEs and whether a market's overvalued, those sorts of things. It's understanding when certain events happen, which asset classes tend to do particularly well. A good example in uncertainty or inflationary times is that we expect gold to rally. And we've got trades running on GLD at the moment, which have been very lucrative. The reasoning this time why gold's behaved in a different way, we talked about crypto, for example, being an offset, if you will, or a replacement for investing in gold. Yet with the attacks on the Ukraine, what that's done is really knocked the guts out of the crypto market, given it's one of the world's biggest crypto mining environments, as indeed is, of course, Russia. And crypto hasn't necessarily performed in the same way, but people have then moved into gold as their hedge. And we've seen great returns there. So that's what's been the catalyst for gold to kick in when it has. We talked about energy prices, as we alluded to in episode 7, series 3, that, given the quantum of energy that comes out of Russia and out of the Ukraine, any disruption to supply or sanctions or anything like that is going to send commodity prices for oil and energy in particular through the roof. And that's exactly what we've seen. If you take coal as an example, Australia, we're very blessed. I guess it's a poison chalice from an environmental perspective. Again, it's something we've talked to quite extensively, but we produce the world's best thermal coal. And so demand for that has gone up, given the fact that markets that typically are competitors, Ukraine and Russia, are now temporarily off limits. And to give you an idea of just how big that move has been, 2 years ago, the shipping costs, and I've always taken interest in Newcastle. We've run some great events down there over the years, either out in Williamstown or in town in the city there. And you see the coal boats going out overnight, 2, 3 of them a day. 2 years ago, coal was $40 a ton. Friday, Newcastle coal, $400 a ton, a tenfold increase
in 2 years,
and a large chunk of that, 40% of that, just on Friday alone. So that upset of the apple cart, that geopolitics, has had a massive and immediate impact on demand for our energy and our carbon products, particularly.
Natural gas also too, a big component of that. From my understanding, a lot of natural gas is produced in Russia and runs through Ukraine to Germany, right? But the Nord Stream 2 pipeline, I believe, is what it's called, has been cut off.
I'd love to see you draw that on the map.
No idea. Geography, not my skill set.
Well, let's take that as an example, and let's actually talk about Poland, which is, of course, one of the countries that border onto the Ukraine. Poland has tried to approach, like everybody, the reduction of carbon emissions, but its coal-fired power stations aren't able to meet its baseline requirements for power. It can't handle the amount of power it needs, and obviously, since Poland has become more ingrained with Europe, there's been huge expansion in that country. And so they do require massive amounts of natural gas from Russia, specifically in order to meet that energy gap between what they need and what they can actually produce under their own devices using coal. Now, of course, Russia's holding all the cards insofar as it's got the pipelines going in and it's got the natural resource there. And Europe at the moment is sort of scatting around. There are trade embargoes and different measures that are being taken to, I guess, express the contempt from the West for what's gone on. on. But you'll be very careful you don't throw the baby out with the bathwater here, because there is a demand and there is a need, and a need that can't really be met from anybody else, certainly close by, for that source of energy. So, whilst sanctions are going to be interesting to see how they perform, my guess would be as you start to get round towards the Northern Hemisphere winter again in a good 6 months' time, and Russia's holding the cards that it is, saying, well, if you want to have a warm winter, you better start relaxing some of these sanctions. And I'd suggest that that's probably the strategy they're playing.
Fluid situation, to say the least. Now, we talk about opportunity AB. So moving forward as a change of pace here, what do you see over the medium term as the opportunity in markets? We talk about fundamentals and strategy selection. If you had to marry those two up, what are you looking at doing?
Well, that's a great question. And I think, we've talked about energy, and I think the next thing we have to talk about is particularly the foods and the grains complex. And over the years, we've done massive amounts of futures trading and training in the futures trading space as an organization. And I remember, way back, probably 17, 18 years ago, prior to the previous commodities super cycle, which I think we're just starting on another one. That was the mainstay of our business. And the grains aren't an exciting area that people typically look at. And what I mean by the grains, soybeans, wheat, and corn being the mainstays in that area. Wheat, especially given its use in the food production chain, is absolutely critical. Corn, interestingly, most corn is made for ethanol. It's actually used for either animal feed or it's actually used for biofuel rather than in the food chain. But wheat is a slightly different proposition. And the Ukraine and Russia, I think, are number 2 and 3 in terms of the world producers of wheat. So if you have economic sanctions against one, being Russia, and in the case of the Ukraine, this is really the time that farmers in the Ukraine ought to be planting their crop for the next harvest. A pretty tough proposition to say, look, get out in your tractor and plant some wheat. Don't worry about the shelling and the missiles landing around you. Get on with it. So there's a very, very good chance that they're going to miss that window for planting. And when it comes to the plant harvest cycle within commodities, grains in particular, once you've missed that window, that's it for the year. There's other things you can plant, but it's not going to be wheat. It might be barley, winter. There's other stuff that you can plant, but they're going to miss this particular window, which then creates a shortage of a commodity that's massively in need. Within the food production cycle, we're already seeing food prices move higher, and that's the sort of thing that can really kick it along further. So, in terms of a trade opportunity with that, I'd be looking at trading in the wheat space in particular. In fact, I'm already looking at that. We're actually doing that right now. Whether that be through an exchange traded fund, which trades a basket of different things within the wheat space, or whether it's getting exposure to that underlying commodity through the futures or using CFDs to get exposure to the futures, matter for you as to which path you take. I like the idea of an ETF. It's just a no-brainer, nice and easy, one click, you're done, and getting some exposure to that. And I think you're going to see that that's going to be a pretty strong performer as that supply is constrained both by the lack of ability to harvest it, 'cause it's not been planted, and the sanctions into Russia.
It's a great point, and it's basic economics. Supply constrained, demand strong, drives prices up. And, from the tenor of that conversation, AB, correct me if I'm wrong, it's got to come down to fundamental analysis.
Yeah, you don't see that in the chart. You're going to see, if you look at a chart on wheat, you're going to see on balance volume increasing, you're going to see it grinding higher, maybe a bit of a breakout, which you're going to see all of those things. But it's understanding the reason why and why this is the start of it, rather than, it's already had a little bit of a pop, it must be done. As the world demands the insatiable appetite we have for food and the need for grains to go in there, wheat is a prime candidate. And you've got your market 2 and 3 pretty much taken out of the equation, both by sanctions and, of course, by conflict. So, that's a terrific example of an opportunity that's presented itself within there for people to be able to profit.
Anything else that you see? Is there any more value left in oil, do you think, with the current situation?
Look, I think as the economy continues to open up post-COVID, looking at flights and travel in general and energy production, I don't think we're tapped out as far as oil is concerned. And again, if there are sanctions against Russia, and I think a lot of people that are talking about sanctions are trying to avoid including energy in that, just to avoid getting caught up in the points that we've alluded to a few moments ago. I do think oil's got more left in it, and potentially considerably more left in it. For a number of reasons. One is a constraint on supply. Number 2 is the expansion of the economy. And if you've got more demand and slower supply, you're going to see prices move north. You're also going to see various constraints in the energy generation space where you need to look at substitutes, for example. So if you can't get natural gas, what's your alternate? Is it an oil-fired power station? Is it coal? If it's coal, that's very good for our market here in Australia. The Chinese are coming around to having to buy Australian coal, as they also, I guess, can't be seen to be cozying up too closely to Russia under the current sort of political circumstance, which again creates a further driver for demand out of the Russian market and into the sort of Western global market. So I think there's good scope for oil to go further too. And as I say, we've got traps well set on that. We've got clients in great profit, and long may that continue. The downside to all of this, as always, is that, and perhaps, from time to time you get people that perhaps are a little cynical, checking in and having a listen, and, you guys talk about, it's exploiting people. We're not exploiting people. What we're trying to do is help our clients, people we've got a duty of care to be able to protect and create wealth for themselves and their families. And the higher energy prices in particular is going to affect your everyday person very heavily. You go to the Bowser, I couldn't fill up. I've just been obviously in the Northern Rivers, where there's a limit on what fuel you can buy, $2.10 a litre at the moment and rising. And so, that's something which is a huge punitive tax on everyday people, because it's such a huge fixed cost every week filling the car up with fuel. And so, that's another inflationary pressure in the Australian economy, likely to see rates rise on the back of it. But it's also something that's got to come out of people's hip pockets. So there's a lot of pain with this. And we're not profiting from that pain. We're just simply trading the price moves there. And I wish more people could learn the skills to say, okay, let's say you've got millions of dollars to do this. You've got $10,000 sitting around. A 10 grand investment in something like USO, if it goes up as it has already 30%, that's just made you $3,000. That's going to take an awful lot of sting out of that extra price rise at the Bowser. I must admit, I'm quite happy going to the Bowser at the moment, because whilst it's pain on filling up, it's very profitable on the other side of the equation, and I've got a decent lick in USO, as our clients have, profiting from that. So, you can be a victim of this, or you can be a victor. It's just a question of which lens you choose to look through, and it is going to get very painful, and my heart goes out to those people. That's why we put this material out in the free to air space, so that people go, there is something I can do to protect myself and my family from higher energy costs. It's going to be a very, very real issue. I think there's definitely more upside in energy prices, not just oil, but across the energy complex.
Great advice, AB, and awesome analysis as well. You make it sound so simple as always, but for anyone listening to this going, how do I get to that level? What's your final piece of advice? Reach out. We'd love to have a conversation. This stuff is all teachable, and it's also learnable. You just got to be open to accepting that there are ways that you can protect yourself to be able to profit through this. And just because perhaps you may have had some success if you're already an investor over the last few years, things have shifted dramatically, and you're going to want to have a significantly higher skill set to be able to really capitalize on this and avoid the volatility that's this broader market. So you need to be very, very selective in where you're lining yourself up, have great risk management in there as well, and have a very clear view. Unfortunately, this is 30 years in this game now, so it's not my first rodeo where I've seen conflict and what that's done to energy prices. The best example of which would have been the Gulf War 1 and 2, which were copybook plays for making sure you got exposure to oil because the price went up through the roof. And this is just another example of that. So success leaves clues, history leaves clues. And if you've got a game plan that's based on what's happened in the past and how things operate, how they're all connected up, then with some level of confidence, you can then expose your money to those opportunities and obviously profit. Opportunities within Turmoil, there's certainly plenty of them, AB. Thanks very much for your time today. Always a pleasure. Thanks, Mitch. There you have it, guys. Make sure you give us a review and a rating, and we'll look forward to hosting you next week.